let's get straight to it. Welcome to today's high-signal, rapid-fire global macro explainer. If you're managing capital or trading the major pairs and indices, you know how absolutely crucial it is to bridge those overnight geopolitical headlines directly to hard technical setups before the opening bell even rings. So today, we are cutting right through the noise to map out the tactical plays for major currencies, USD INR, and the Indian equity markets.
We've got to start with the massive geopolitical risk premium that is just hanging right over the markets right now. What we are witnessing in the Middle East is basically history's most unconventional ceasefire. I mean, both sides seem to occasionally forget they're actually supposed to stop shooting. Fresh Iranian attacks on shipping in the Strait of Hormuz triggered retaliatory U.S. strikes, and it prompted a very severe warning from Washington, specifically President Trump warning that Tehran could face existential consequences if things escalate. Now, initially, markets kind of brushed this off as yesterday's problem. But this latest exchange, it is a stark reminder that geopolitical risks rarely follow the script we want them to.
And honestly, that perfectly captures the wider macro picture we are tracking right now. Look beyond the geopolitics for a second. The underlying U.S. economy remains remarkably resilient. We did see softer PCE inflation data last week, but Wall Street still struggled. Why? Well, it was mostly driven by technical sell-offs in tech. Think quarter-end rebalancing, crowded positioning, and tax loss harvesting, rather than any real shift in the fundamentals. Meanwhile, the Federal Reserve, they remain visibly divided on the path forward. And looking eastward, we've seen these sharp leverage-driven swings across Japanese and Korean financial markets, which is definitely reigniting some contagion fears.
Looking at our timeline for the week ahead, Thursday's U.S. payrolls and JOLTS data is going to be the big one. We follow that up with the ECB and Sintra, China's PMI readings, and then India's industrial production numbers.
Moving right along to the major currencies' tactical playbook, let's dive straight into the charts.
Starting with the linchpin of it all, the DXY. We finally saw a crack form on the back of the rapid fall in crude prices, with the bond markets reacting super late to that. But here's the crucial takeaway. Despite that sharp fall, the overall structure completely screams, buy on dips. Overhead resistance is sitting right at 101.41 and 101.80, while solid support anchors us at 189. The catalyst moving these levels is the CME pricing, which currently shows an 80% probability of a rate hike by December. Sure, markets scaled those odds back a tiny bit after the May PCE print, but the underlying analytical view we're taking? The Fed is actually likely to just hold this year.
Let's see how this plays into the euro. Euro-USD recovered as the dollar slipped, but it's still hanging out in that one-year low zone. We noted recently this pair was very oversold, so a pullback was totally due. Tactically, we're treating this as a sell on rise. Watch for sellers at resistances around 1.1388 and 1.1447, with downside support at 1350. Also, keep your eyes peeled today. ECB President Lagarde is speaking. This comes right after the ECB updated their June projections, pushing their Eurozone headline inflation forecast up to a very sticky 3.0% for 2026. Over to the British pound. GBP USD bounced off the 1.3150 support line, tracking that broader dollar drop. But again, the overarching structure here is absolutely a sell on rise, with resistance looming at 1.3265. What's driving this? Well, the pound is caught in a massive tug of war right now. On one hand, a hawkish minority at the Bank of England is offering some support. But on the other, you've got dual headwinds, political uncertainty highlighted by the recent Andy Burnham by-election, and a noticeably looser domestic growth picture.
Now for USD JPY, which is just giving us some truly incredible price action. Markets have aggressively tested the Bank of Japan's resolve at the 161.94 resistance every single day this past week. Normally, the broader structure for this pair is a buy on dips. But tactically, given extreme overbought conditions and the huge looming threat of coordinated intervention, the better risk-reward trade is to actually sell right here, against that stubbornly tested 161.94 resistance. Just make absolutely sure you keep a very tight stop at 162.0. If we break above that, it opens up a massive upside target of 164.60. Support below sits at 160.55 and 159.77.
All right, shifting gears to our India macro and equity setup. Let's see what's happening regionally.
Indian markets actually had a highly constructive week thanks to a macro combo traders love, softer crude prices, falling bond yields, and easing rate concerns. Looking at the currency, the rupee outperformed its regional peers, closing at 94.3950 per dollar. That strength came from foreign portfolio inflows and likely RBI intervention. The month-end dollar demand from importers did cap things a bit.
Structurally, USD INR is a clear sell-on-rise opportunity. Your resistance levels are mapped at 94.51 and 94.92, while support floors are waiting at 94.06 and 93.66.
Real quick, before we hit the exact Nifty levels, I want to highlight some wild internal market divergences. While financials and pharma surged this week, metal stocks took a 4.4% hit, tracking weaker global prices. It's just a great reminder to always look under the hood of those headline index numbers.
Speaking of the headline index, the Nifty 50 notched its third straight weekly gain, ticking up to 24,056. Private lenders really led this charge, reacting positively to the RBI rolling out measures for better funding flexibility on foreign currency deposits. Tactically, we're maintaining a buy-on-dips posture. Watch for a stubborn resistance up at 24,344. On the downside, we've got ironclad support at 23,900, and right below that at 23,787, which is basically a massive confluence of the 21 and 50 weighted moving averages.
So, as we wrap up this morning's explainer, the million-dollar question is this. With deep central bank divergence, we're talking a hawkish Bowie minority, a divided Fed, and an intervening BOJ, plus heavily hovering geopolitical risks in the Middle East, how are you tactically positioning your portfolio for the week ahead? Take a good look at these technical levels, map them against your own risk tolerance, and remember, trade the structure, not the noise.